Hi, this is Cindy. Welcome to Module 7D. In Module 7D, we're going to discuss the financial statements. And let me tell you, first of all, there are some things in here, okay, that you're going to have to memorize, okay? Because there is a chance that they could ask you to prepare financial statements. Now, they're going to ask you to prepare financial statements. They're more likely to ask you to prepare an income statement and a statement of cash flow than they are to require to prepare a balance sheet, only because a balance sheet is really much longer than an income statement and a statement of cash flow. The statement of cash flow is not discussed in this module. Statement of cash flows are discussed in Module 15. I'll do that. I'll be doing statement of cash flows with you. So we're going to discuss the income statement and the balance sheet. On page 128 is a classic example of a multiple-step income statement, and it's actually called a statement of income and comprehensive income because it does have some items below net income called other comprehensive income items, which we'll talk about. This is on page 128, which is the beginning of Module 7D. Then, on page 132, there's a classic example of a classified balance sheet. Classified balance sheet is classified in terms of according to time, where the assets are divided into current and long-term assets. The liabilities are divided into current and long-term liabilities. And then you have your shareholders' equity, where the assets are on the left-hand side and the liabilities and shareholders' equity are on the right-hand side. This is found on page 132. This is called the T account format for reporting the classified balance sheet because you have the debits on the left and the credits on the right. If you had the report form of a classified balance sheet, the assets would be on the top, liabilities and shareholders' equity would be on the bottom. They are more likely, if they're going to ask you to do a balance sheet, to ask you to report it in the report format, which is assets on top and liabilities and shareholders' equity. But they're less likely to ask about the balance sheet. They're much more likely to ask about the income statement and the statement of cash flow. But the statement of cash flow is discussed in Module 15, not in this module. Anyway, you're going to have to develop a familiarity with where the accounts are on page 132 for the classified balance sheet. So you need to read all these. You need to make note that the assets are divided into current assets and the long-term assets. The long-term assets consist of long-term investments, property, plant, equipment, intangibles, and then other. And then on the right-hand side, you're going to have your liabilities and shareholders' equity. The liabilities are divided into the current liabilities and the non-current liabilities. Then the shareholders' equity is divided into capital, stock, additional paid capital, retained earnings, accumulated other comprehensive income, then the treasury stock, and final total liabilities and shareholders' equity. So develop a familiarity with what's on the balance sheet. Now for the multiple-step income statement, this classic example is found on page 128. It is actually a statement of income and comprehensive income because it does have some items below net income, and we will talk about comprehensive income. We did talk a little bit about comprehensive income back in Module 7A, but that was the statement of financial accounting concepts definition of comprehensive income. Now we're going to discuss the statement of financial accounting standards definition of comprehensive income, and that's a different definition. All right, beginning on page 128, with our classic example of the multiple-step income statement. Income statements can be in two forms. They can be in multiple-step form or single-step form. The more difficult form is the multiple-step. They are more likely to ask you to produce a multiple-step income statement. Just so you know, I just want to put on here what are the multiple choice that you should do for the multiple choice questions that you should do. Number 3, 9, 10, 11, 25, 26, 27, 35, 37, 40, 41, 42, 55, 57, 59, 60, 61, 62, 63, and 65, 66, 68, 69, 70, 71, 74, 75, 76, 83, and 84. There also are 21 keywords, and I'm going to go over what are the 21 keywords that you have to know. And then also simulation number 3. I want you to do simulation number 3. Simulation number 3 found on pages 158 to 160. I will only want you to do the multiple step income statement and the statement of retained earnings only. So once again, for simulation number 3, I only want you to do the multiple step income statement and the statement of retained earnings only. The solution is found on pages 180 to 181. Now let's get over and done with those 21 keywords. Keywords are found at the back of the chapter. Please turn to page 142. I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. Okay, please turn to page 142, and you're going to get out your pen, and there's some keywords. Remember the keywords, you just have to develop a familiarity with the keywords so that if you had to do some research on these topics, you already are familiar with these words, and you put them in the search function and search in your topical index. On page 142, do you have your pen ready to check off? In the far left-hand column, at the bottom of page 142, I want you to check off balance sheet, then change in principal, then changes in entity, then changes in estimate, then comprehensive income, then cost approach. So once again, in the far left-hand column, it's balance sheet, change in principal, changes in entity, changes in estimates, comprehensive income, and cost approach. Then the middle page 142, the fifth one down, discontinued operation, then extraordinary items, then the fair value hierarchy, then the fair value option, then impairment loss, and then the income approach. Once again, in the middle column, discontinued operation, extraordinary items, fair value hierarchy, fair value option, impairment loss, and income approach. On the far right-hand column, is infrequency of occurrence, then market approach, then other comprehensive income, then prior period adjustments. Once again, that's infrequency of occurrence, market approach, other comprehensive income, and prior period adjustments. Turn to page 143. There's only one keyword I want you to check off. On the far right-hand column, unusual nature. Then I need you to write down 4 more keywords. The 4 more keywords are, number 1, classified balance sheet. Number 2, multiple step income statement. Number 3, single step income statement. And number 4, accumulated other comprehensive income. These are not anywhere on the list, so you have to write them down. Once again, the 4 terms I want you to write down are classified balance sheet, multiple step income statement, single step income statement, and accumulated other comprehensive income. Okay, let's go back to page 128 and talk about what is going on here on our multiple step income statement. Income statements can actually be in 2 forms, the multiple step form and the single step form. The multiple step form is more difficult. The single step form just basically takes all the revenues and all the expenses, all the revenues and gains. You can see that it's right at the bottom of page 128. Take all the revenues and gains, turn to page 129, then they have all the expenses and all the losses. That will then give you income from continuing operations before income taxes. So they don't really stratify like what's more important versus what's less important. They sort of like jumble all the revenues and gains together and jumble all the expenses and losses together. What's so much better about the multiple step income statement is it does arrange them in priority, where the more important revenues and expenses are at the top, and less expenses, the less important gains and losses are towards the bottom. And then there also is a bunch of different types of subtotals in the multiple step income statement. There's the gross margin or gross profit, and in particular operating income, operating profit subtotals that really do provide a lot of good information and performance measures when you're looking at an income statement. Anyway, the multiple step income statement will always start off, let me get a new pen. This one seems kind of tired. Okay, so we have, I don't know if this one will be much better, but there's tons of pens there right now. So we're going to start off with the income statement first, and this happens to be a statement of income and comprehensive income. Always when you do a financial statement, you always start with the name of the company, then you're going to put the name of the statement. In this case, this is going to be a multiple step income statement. Then you always put some sort of a date format. For income statement, it's for year ended, and then you fill this in with a balance sheet date. I'll just say 12/29/2009. Oh, this one is kind of tired too. Then you're going to start off with, oh, this is good, your net sales. Okay, now it does no good to say net sales unless you know how to calculate net sales. The calculation for net sales is you take your gross sales minus your sales discounts minus your sales returns and allowances. This will then equal your net sales. So you're going to take your net sales, you're going to subtract your cost of goods sold or cost of sales. That's the same thing. Now, it does no good to put down cost of goods sold or cost of sales unless you know how to calculate the cost of goods sold. The way you calculate your cost of goods sold is you're going to take your beginning inventory plus your cost of goods purchased. This equals your cost of goods available for sale minus your ending inventory. That equals your cost of goods sold or cost of sales. Now, no, cost of sales, Cindy. Now, this does no good unless you know how to calculate cost of goods purchased. The way you calculate your cost of goods purchased is very similar to net sales. You take your gross purchases minus your purchase discounts minus your purchase returns and allowances. This is going to give you your net purchases. To this, you add your freight in or transportation in. This is going to give you your cost of goods purchased. The cost of goods purchased then goes here. You calculate the cost of goods sold, and that then comes here. So then you take your net sales minus your cost of goods sold or cost of sales. This will equal your gross margin or gross profit. From that, you'll subtract your operating expenses. And there are more operating expenses than what they have written down here. Your operating expenses consist of your selling expenses, your general and administrative expenses. Typically in accounting, we call that G&A, or sometimes they just call them administrative expenses. So general administrative expenses or G&A or admin expenses. You're also going to have your organizational costs here. Also included in here would be your research and development costs, R&D costs or R&D expense. One other thing, impairment loss. You include the impairment loss here. That's impairment loss, but this is going to be for your SEC registrants. If you're a publicly traded company and you have an impairment loss, you must report it here amongst the operating expenses. So your operating expenses are your selling expenses, your general administrative expenses, your organizational costs, research and development costs, research and development expense, same thing, and your impairment loss. The impairment loss goes here if you're an SEC registrant. This will then equal your operating income or your operating profit. Then you will continue on. Erase this now. Starting off with the operating income or operating profit. To that you'll add plus, that's good, Cindy, plus your other revenues and gains. What are examples of other revenues and gains? If you have a gain on disposal of a piece of equipment, that would go here. If you have an unrealized holding gain on a trading security, that would go here. Also, if you have any equity in earnings of investee, that's equity method revenue under the equity method of accounting for investments, that would also go here. Also, interest revenue would go here. Those are typical examples of other revenues and gains. Minus other expenses and losses. Classic examples of other expenses and losses, once again, would be on your unrealized holding loss for trading securities. Also, examples of other expenses and losses would be interest expense. Also, if you had any losses on disposals of equipment, that would also go here. This will then give you income from continuing operations, but this is before taxes. Okay. And I'll just point out to you here, from here on down, it's the exact same format between a multiple step format and a single step format. In a single step format, it takes all the revenues, which are here and here, and then all the revenues and gains minus all the expenses and losses. And all the expenses and losses would be here, here, and here, and just puts them all together. So all the revenues and gains minus all the expenses and losses gives you income from continuing operations before taxes. But here we sort of prioritize them, put the most important expenses up at the top, and the farther you go down, the less important the expenses become. Put the most important revenues at the top, and the farther you go down along, the less important they become. Okay, And plus, in the multiple step income statement, we calculated a couple of very key subtotals. The subtotals include gross margin, gross profit, and the operating income or operating profit. Oh, by the way, this is also called earnings before interest and taxes. The operating income or operating profit is also called EBIT, earnings before interest and taxes. Once you get to here, it's the same between multiple step and single step. So then you have your income from continuing operations before taxes. You subtract your income tax expense. You'll learn that when you do deferred income taxes, which I believe is module 13 or 14, I don't know, Phil does it with you. For the income tax expenses, they're both deferred and current portions. There's a current and a deferred portion of your income taxes. That's your income tax expense. You subtract that from income from continuing operations. This gives you income from continuing operations. This is now net of tax effect. To this, you'll add plus or minus your discontinued operations. Discontinued operations are reported net of tax effect. From that, you say plus or minus your extraordinary gains and losses. This is also net of tax effect. And then finally, you will have your net income. Now, it may or may not stop here, depending on the format of the income statement you choose. If you decide to do a statement of income and comprehensive income, there's more items that fall below the net income. If you just do a statement of income, an income statement, it stops at net income or earnings. Okay? Why don't we go ahead and take a look at what they're showing here on page 128, just the income statement portion. Once again, you have your sales, but really it's net sales minus your cost of goods sold equals gross margin. You remember that gross margin is the same thing as gross profit. Then you have your operating expenses, which consists of selling expenses and general administrative expenses. Remember, you have other types of expenses, including organizational costs, research and development expense, and impairment loss of SEC registrants. So you subtract your operating expenses from your gross margin or gross profit. That gives you operating income. Operating income is also known as operating profit. It's also known as earnings before interest and taxes, or EBIT. Then you add your other revenues and gains. Here's your operating income or operating profit. I just carried this forward up to here, also known as EBIT, earnings before interest and taxes. Add your other revenues and gains. Classic examples are interest revenue. By the way, when they say the gain on sale of available for sale securities, that's considered to be a realized gain on available for sale securities. You are allowed to show an unrealized gain on available for sale securities, but only if you elect the fair value option under standard number 159. I will talk a little bit about standard number 159 for the fair value option in this chapter, but it predominantly relates to investments, and I believe that Mike is going to be talking to you mostly about investments in a different module. Then you also have minus your other expenses and losses. The typical examples of other expenses and losses would be your interest expense. Now, they do show here a loss from impairment of a manufacturing facility, but I want you to look down at the notes at the bottom of the page in the notes. Item number 4 in the notes, it says, in the multiple step format, the Securities Exchange Commission requires that public companies place impairment loss in operating income. Here's the calculation to operating income, so impairment loss has got to come before operating income, all right, instead of other expenses and losses. So if you're a publicly traded company, impairment loss for SEC registrants, a publicly traded company is called an SEC registrant because they are registered with the SEC. That's because they're publicly traded. Impairment loss for SEC registrants is reported here. If you're not publicly traded, you're allowed to report your impairment loss here, okay? But that's only if you're not publicly traded. This will then give you income from continuing operations before taxes. Subtract your income tax expense, which is both a current and a deferred portion. This will give you then income from continuing operations net of tax. To that, you add your discontinued operations net of tax. To that, it's plus or minus, depending on whether it's a gain or loss. Your extraordinary gains or losses could be a gain or loss, depending on it. And then you finally have net income or net earnings. We'll talk about the other comprehensive income later. So what they could do is they could ask you to prepare a multiple step income statement. I did assign you simulation number 3. I am not going to do the simulation. I solved the simulation, and it's a very good simulation, so I think I just want to assign that to you, and you can do that at home on your own. Remember that I assigned simulation number 3. Just the portion for the multiple step income statement and statement of retained earnings only. It's found on pages 158 to 160, and the solution is found on pages 180, 181, $1,000,000,881. It's a very good example of a multiple step income statement, a statement of changes in retained earnings. I do want to go ahead and take a look at some multiple choice questions on this. So let's take a look at multiple choice question number 3, please. Multiple choice question number 3 is found on page 144. So multiple choice question number 3 on page 144 says, now this is part of a block of questions. Number 2 and 3 are a part of a block of questions. I don't need you to do number 2. I just want you to do number 3. Number 2 is mainly about cost accounting, and we already did that in BEC. Number 3 says, 3 is found on page 144, the stem. Remember, you always start with the stem of the question first. 3 says, what amount should Vane report as income after income taxes from continuing operations? So they're specifically asking for income from continuing operations net of tax effect. All right, items 2 and 3 are based on the following. The Vane Company's trial balance of income statement accounts for the year ended December 31st, 2009 included the following. What's nice about this is this trial balance, so give you debits and they give you the credits. All right, so we have sales is $575,000. We have cost of sales, admin expenses, loss on sale of equipment, sales commissions, interest revenues, freight out, loss on the early retirement of long-term debt, uncollectible account expense, and then they give us some totals. Then they also give us some beginning and ending inventories. They tell us our income tax rate is 30%, and in Vail's 2009 multiple step income statement for number 3, they want to know what amount should Vane report as the income after income taxes from continuing operations. So that's this item right here. All right, so what you would do to solve this problem is on your scratch paper, you would set it up as your multiple step income statement format. We start off first with net sales. Now you do have sales of $575,000. Now remember that for the net sales, you would have to take the gross sales minus the sales discounts, minus the sales returns and allowances. It doesn't seem like we have any sales discounts. It doesn't seem like we have any sales returns and allowances, but always be careful, always to check for that. So this $575,000 here must be our net sales, so I'll just put that, $575,000. Then they give us our cost of sales. Cost of sales is the same as cost of goods sold, so I'll say minus 240. So that would be 335. This is my gross margin or gross profit. Then they give us our admin expenses. Our admin expenses are general administrative expenses, so that's 70. Put that there. Then they give me loss on sale of equipment. The loss on the sale of equipment is an other type of expense item. So that would be over here, other expenses and losses. That would be minus 10 for the loss on sale of equipment. Then we have a sales commission. A sales commission is a selling expense. Selling expenses are all costs that you incur in order to increase sales. Once again, selling expenses are all costs that you incur in order to increase sales. Typical examples of selling expenses include sales commissions, but they can also include depreciation expense on the sales showroom, because you do make all your sales in your showroom. The depreciation expense is considered to be a selling expense. Also, if you had some delivery trucks where you're delivering items to your customers, then the depreciation expense on the delivery trucks would be considered to be a selling expense. Also, freight out or transportation out is considered to be a selling expense. Have you ever got on the internet and as a customer and you ordered something just because the internet store was offering free shipping and handling? Well, you're more likely to buy something on the internet if the store is giving you free shipping and handling. Isn't that right? I know I am. The reason that the internet store is giving free shipping and handling is because they know that that is an inducement for sales. People are more likely to buy if shipping and handling is free. So what they do is they pay to ship the goods from their store to their customers. That's considered to be freight out or transportation out. It is considered to be a selling expense. Other examples of selling expenses are bad debt expense and warranty expense. You give a good warranty on a product, and the good warranty is a selling point. So warranty expense is considered to be a selling expense. Also, you grant credit to a customer. When you grant credit to a customer and you take an account receivable instead of just selling for cash, that's also considered to be an inducement and increase to sales. You offer credit in order to increase sales. Of course, when you take the account receivable because you offered your customer credit, not all the accounts receivable are going to be collectible, so then you end up with a bad debt expense. So that's why bad debt expense is also considered to be a selling expense. So once again, all costs that you incur in order to increase sales, including depreciation on the showroom, depreciation on the delivery trucks, bad debt expense, warranty expense, freight out. These are all classic examples of selling expenses. So when they have the sales commissions, these are what you pay your salespeople whenever they make a sale. That's considered to be a selling expense. So I'll put the 50 here. So the selling expense, that's 50 right here. And then we have interest revenue. Interest revenue is a type of other revenue. So the interest revenue of other revenue is 25. So I'll put that here in other gains and losses. Excuse me, other revenues and gains. Other revenues and gains. Then we have freight out. Freight out is considered to be a selling expense, as I explained to you. So we have selling expenses already of 50 for the sales commissions, and then we have freight out of 15. So we're going to add another 15 to the 50, so the selling expenses now are a total of 65. And then we have loss on early retirement of long-term debt. The loss on the early retirement of long-term debt is an other type of expense or loss. We already have a loss of 10 from the loss of sale of equipment, so we're going to add another loss of 20 to that. So now my total loss is going to be 30, which consists of the loss on disposal of the equipment plus the loss on the early retirement of debt. Then you have uncollectible account expense. Uncollectible account expense is the same thing as bad debt expense. I already told you that's a selling expense. So far we had selling expenses of 50 for the sales commissions and 15 for the freight out. To that, we're going to add another 15 for uncollectible account expense, which is also the same as bad debt expense. So now my total selling expenses is going to be 80. And so we're just going to go ahead and calculate the income from income taxes from continuing operations. Doesn't seem we have any organizational costs, so those are 0. Doesn't seem we have any research and development costs. We don't have any impairment loss. So we're going to have a gross margin or gross profit of 335, subtract my selling expenses of 80, subtract my general and administrative expenses of 70. So 335 minus the 80 minus the 70 is going to give me operating income or operating profit of 185. That's also known as earnings before interest and taxes. So then we have 185 here. To that I'm going to add plus my other revenues and gains of 25. So 185 plus 25 minus my other expenses and losses. So when I take that, I have my 185 plus the 25 minus the 30 is going to give me 180. 180 is my income from continuing operations before income taxes. Then I'm going to subtract my income taxes. They're telling me that my income taxes is 30%. So 18 times 30%, 180 times 30% is going to give me 54. So 180 minus the 54 is going to give me 126 as my income from continuing operations net of tax. Let's see if I can answer my question. Number 3 says, what amount should Vane report as income after income taxes from continuing operations? They're asking for income from continuing operations, net of tax effect, so the answer is $126,000, and the correct answer is A. You're allowed to choose A, but only if you're sure. And in between that, they could have asked for any of the subtotals. They could have asked you what is the total selling expenses. The total selling expenses consisted of $80. The $80,000 consists of $50,000 for the sales commissions, $15,000 for the bad debt expense, and $15,000 for the freight out. They could have asked you what's the total operating expenses. The total operating expenses would have been the selling expenses of 80 plus the administrative expenses for 70. It's a total of 150 for the operating expenses. So then 335 minus the operating expenses of 150 gives you operating income or operating profit of 185. They could have asked for the operating income or operating profit. They could have asked for the other items. The total other items were for other revenues and gains was a total of 25. For minus other expenses and losses was a total of 30. I believe the other expenses and losses of 30 consisted of the loss in the sale of equipment of 10, and then the loss in the early retirement of long-term debt of 20, so that made up that 30. They could ask you what were the other expenses and losses, and you would have to know that goes in that category. They could have asked you what's other revenues and gains. You would have to know the 25 that you incurred for the interest the 25 that you earned for the interest revenue, that would be considered to be an other revenue and gain. So they could really ask you for basically any line line or any category of the items in the multiple step income statement, which is why it's so important, and why it's so important that you have to know the multiple step format, which is found on page 128. Plus, you also have to know the classified balance sheet format, which is found on page 132. Don't forget about that. You have to know that format too for the classified balance sheet. As I get on through more and more modules and I talk about different items, because what we're going to do is we're going to gradually go down the balance sheet. We're going to talk about inventories. We're going to talk about property, plant, and equipment. We're going to talk about liabilities. I'll refer back and forth to the balance sheet on page 132, but make sure that you review that and you learn all the different components and where they go. You have to have a very strong familiarity with the balance sheet. But as I said, they're more likely to ask a multiple step income statement and a statement of cash flow than they are to ask for the balance sheet, only because the balance sheet is just so long, would take forever. And would they ask it, it would be in a simulation, okay? All right, let's see then if we can take a look at some other things. Now, after the income from continuing operations, the next item that we have is a discontinued operation. The discontinued operations are discussed on page 130. So let's take a look at page 130 and let's talk about discontinued operations. On page 130, about 1/4 the way down the page, on page 130, it says item number 3, a discontinued operation. And it says, as shown on the income statement, they're talking about the income statement that's on page 128, okay? As shown in the income statement, discontinued operations is broken out separately. You have the loss from discontinued operations. That includes the loss or income from the component of the period, and then the gain or loss from disposal. And then they have a separate line for income taxes, so that the income tax or tax benefit is deducted from or added to that amount to determine the gain or loss after taxes. I'm on page 130. I'm about 1/3 the way down the page. I'm reading item number 3 on the discontinued operations. To qualify for treatment as a discontinued operation, the assets must comprise a component of the entity with operations and cash flows that are clearly distinguished operationally and for financial reporting purposes from the rest of the entity. A component may be a reportable or operating segment, a reporting unit, a subsidiary, or an asset group. What's going to happen is that companies, you know what they like to do? They'd much rather report something as a discontinued operation than report it as a continuing operation, because income from continuing operations is a very serious measure. People track that measure on the income statement. They look at this. They don't necessarily look at a discontinued operation because that's a one-in-a-lifetime chance. That doesn't happen all the time. Same thing for extraordinary gains and losses. These items are non-recurring. Income from continuing operations is recurring, meaning that it happens every accounting period. So this measure is tracked much more for measuring performance. So what happens is that when companies are trying to isolate something that's done really poorly, they try and stick it into discontinued operation so it doesn't mess up their measure for continuing operations. That's why companies play lots of games between whether they're going to put it in the calculation for continuing operations or put it here in the discontinued operations. That's why the accounting standard is so strict in what can go as part of a discontinued operations, because they know that companies want to put it here and they're trying to game it. So what happens is that there's a series of 8 criteria, and you have to meet all 8 of the criteria in order to be called a discontinued operation and put it in that section of the income statement. What I'm borrowing from Al Gore, you have to put it into the black box. That's called the discontinued operations black box. You must meet all of these 8 criteria before you can throw it in the box and report it here instead of reporting as part of continuing operations. Now, the 8 criteria are in the middle of page 130. They say, in the middle of page 130, many of the assets disposed of as a discontinued operation are long-lived assets. These assets are subject to the requirements of standard number 144. Accordingly, a component is classified as a discontinued operation in the first accounting period where it meets the criteria as being held for sale, plus it must meet all of these 8 criteria. The 8 criteria are: A, management commits to a plan of disposal. So there's a plan. Letter B, the assets are available for sale. What does that mean? That sounds so obvious. Well, no, not really. Because what happens is somebody is suing you about who really owns those assets. Then they're not really available for sale. So what they're saying there is the assets are not encumbered in any manner. Letter C, there's an active program to locate a buyer. So we're trying to find a buyer for this asset. Letter D, the sale is probable. Probable means that it's more likely than not, which is a greater than 50% chance that the sale will occur. Letter E, the asset is being actively marketed for sale at a fair price. We're asking a fair price. Letter F, it's unlikely that the disposal plan will significantly change. Now there's two more. They are G and H, and they're right below it. It says to be reported as a discontinued operation, Standard 144 also requires, number one, the operations and cash flows of the component have been or will be eliminated from the ongoing operations of the entity as a result of this disposal. And number two, the entity will not have any significant involvement in the operations of the component after disposal. So when they say the operations and cash flows of the component will be eliminated from the ongoing operations, that means that you're throwing it into the box. And then when they say that, there will be they will not have any significant involvement in the operations. That means they're surrendering control of the item. So all 8 of those criteria must apply before you can put it as a discontinued operation. And in the first accounting period that it applies, you take everything related to that portion of your business, all the revenues, all the gains, all the impairment loss, all the expenses, all the losses. Everything goes into the box and it gets reported here as part of discontinued operations. There are 2 lines for it. All the gains, losses, expenses, and revenues, and the impairment loss. And there's a line, and then there's another line separately for the taxes. So this really consists of 2 lines, and then they add them together. That's the discontinued operations. It is shown net of tax effect. Remember, there's a single line for those taxes. If you have any questions about that, all you have to do is take a look out on page 128, where we are back to our multiple step income statement. In the dead center of the page, they have a discontinued operation. They have loss from the operations of the discontinued division Z on page 128. I'm looking at the dead center of the multiple step income statement, and then they have a line for the income tax effect. Okay, let's see if we can take a look at some multiple choice questions on this. I'd like to take a look at multiple choice numbers 25 and 26, please. 25 and 26. Multiple choice numbers 25 and 26 are found on page 146. Number 25 and 26 on page 146. Number 25 on page 146, the stem says, in its income statement for the year ended December 31st, 2008, how should Deere report the component operations from January 1st to October 15th, 2008? 25 says, on January 1st of 2008, the Deere Corporation met the criteria for the discontinuance of a business component. That means they met all 8 of those criteria, which are found on page 130. Okay? For the period January 1st through October 15th, the component had revenues of $500,000, expenses of $800,000. The assets of the component were sold on October 15th, 2008, at a loss for which no tax benefit is available. Its income statement for the year ended December 31st, 2008, how should Deere report the component's operations from January 1st to October 15th, 2008? Well, in the accounting period where you first meet all 8 of those criteria for a discontinued operation, that means you can draw a box around it, throw everything into the box, and report it as part of a discontinued operation. They're telling them that on January 1st of 2008 that you met all 8 of those criteria. So that means that the revenues of $500,000 and the expenses of $800,000 will be thrown into the box and reported as part of a discontinued operation. So let's take a look at letter A. The $500,000 and $800,000 should be included with revenues and expenses respectively as part of continuing operations. Well, you would only report those as part of continuing operations if you had not met the 8 criteria for a discontinued operation. But they're telling you that they did meet the criteria for a discontinued operation as of January 1st, 2008. So that means it goes as part of discontinued operations, and A is not correct. Let's take a look at B, like Barbara. $300,000 would be reported as part of the loss on the operations and disposal of the component. That's correct. The reason it's a $300,000 loss is because you had $500,000 of revenues and $800,000 of expenses. When you net them together, it's a $300,000 in losses, and that would be reported part of the discontinued operations because you already met all 8 of the criteria as of January 1st, 2008. What about answer C? $300,000 should be reported as an extraordinary loss? No, this is not an extraordinary loss. Letter D, $500,000 should be reported as revenues from operations of a discontinued component. Well, that's partially true, but what about the expenses of $800,000? So the best answer for number 25 would be B, like Barbara. The revenues of $500 and the expenses of $800 net together for a loss of $300, and that's reported as part of the loss on operations and disposal of the component. Let's take a look at multiple choice number 20. I said number 25 and 26. Isn't that right? Yeah, 25 and 26. Let's take a look at number 26, please. Number 26. Number 26 is found on page 146. Number 26 says, which of the following criteria is not required for components results to be classified as a discontinued operation? Let's briefly review what's required to be called a discontinued operation again. On page 130, go back to 130, the 8 criteria are in the dead center of the page. Letter A, management commits to a plan of disposal. Letter B, the assets are available for sale. Letter C, an active program to find a buyer. Letter D, the sale is probable. Letter E, the asset is actively marketed for a fair price. Letter F, it's unlikely the disposal plan will change. Then the other two, letter G and letter H, are right below it, the operations and cash flows will be eliminated from the ongoing operations of the entity as a result of the disposal. And number 2, the entity will not have any significant involvement after disposal. So they can isolate all the operations and throw them in the box, and they won't have any continuing involvement. They're surrendering control of the asset. So let's go back to number 26. Number 26 says, 26 on page 146, which of the following criteria is not required for components results to be classified as a discontinued operation? Let's start with the bottom and move our way up. Letter D, like David, the entity will not have a significant continuing involvement in the operations of the component after disposal. Well, that is required for criteria for a discontinued operation. They want what is not required, so it's not answer D. How about answer C? The operations and cash flows of the component will be eliminated from the operations of the entity as a result of the disposal. Well, that is required. In the question, they want what is not required, so it's not answer C. C is required. Answer B, the component is available for sale. Yeah, that's true. We're not suing anybody over who owns this thing. So that is required. We want what is not required. How about answer A? Management must have entered into a sales agreement. No, you don't have to have already sold it and entered into a sales agreement. You just have to be looking for a buyer. Okay? And then, of course, the price is fair. Isn't that right? Okay, so the best answer for what is not required for a discontinued operation is A. You don't have to have sold it already. You could just be looking for a buyer. All right. The next thing that comes after the discontinued operations are the extraordinary gains and losses. A little discussion of the extraordinary gains and losses are found on page 129. On page 129, towards the bottom of page 129, at the top, they have a nice little, on page 129, sort of like 1/3 of the way down the page, they have a nice little table there. Go ahead and read that table. I'll just read it really quickly. Item 3 in the table on page 129 talks about an extraordinary item. An extraordinary item is an unusual and infrequent non-recurring event which has a material effect, and it's placed as a separate category after the discontinued operations. So extraordinary gains and losses comes after discontinued operations. Now drop down on page 129 to where it says item number 2. Okay, item number 2. Okay. First of all, in order for something to be an extraordinary item, it has to be both unusual and infrequent. Unusual means that it's never happened before. Infrequent means you don't expect it to recur in the foreseeable future. So unusual means it hasn't happened before. Infrequent means you don't expect it to happen again. So if something is both unusual and infrequent, then you can put it as part of an extraordinary gains and loss. Okay? Now what I'm going to do is I'm just going to take a minute, because they don't really ever deal with it very well in the chapter. I'm going to tell you some things that are always extraordinary, and then I'm going to tell you some things that are never extraordinary. So I'm going to write those things down for you so you understand them. Okay. Always extraordinary. Things that are always extraordinary consists of, number 1, both unusual and infrequent. Both unusual and infrequent. Plus, you have to be able to estimate it. So it's estimable. So it has to be both unusual and infrequent, and you have to come up with an estimate for it. So it's estimable. Also, the things that are always extraordinary include negative goodwill. But only under SFAS number 141, which is the old accounting standard for business combinations. So this is only until May 31st, 2009. If you take the CPA exam, of course there is no exam in June of 2009 because that's not an open testing window. But only up until May 31st, 2009 will they be testing the old accounting standard on business combinations and consolidations. And then negative goodwill is always extraordinary. After that, beginning on July 1st, negative goodwill is ordinary. Okay? So this is one of those things where at least it's a cutoff. You don't have to know both standards. Until May 31st, negative goodwill is always extraordinary. Beginning July 1st, because there's no CPA exam in June 2009. Beginning July 1st, 2009 until the end, and then going forward, negative goodwill is considered to be ordinary under standard number 141 revised. Okay, and standard number 141 revised for business combinations consolidations takes effect on the CPA exam beginning July 1st. So this is always extraordinary. So what are things that are never extraordinary? Never extraordinary. Items that are never extraordinary include any write-downs of assets. This includes, like you do a write-down or a write-off, this includes accounts receivable, notes receivable, inventories, property, plant, and equipment, and goodwill. Whenever you impair something or you write something down, it's never considered to be extraordinary. Also, anything related to a foreign currency devaluation. Anything related to a foreign currency devaluation is never considered to be extraordinary. One last thing, the effects of a strike. The effects of a strike are never considered to be extraordinary. Now, be careful, though. Never extraordinary does not mean ordinary. Never extraordinary means it doesn't fall in E. There's two other places where it could fall. When I say E, when we have our multiple step income statement, I typically say I, then D, then E. I stands for income from continuing operations, then right below it we have discontinued operations, and then right below that we have extraordinary gains and losses, and finally we have net income, all right, and then it ends on the multiple step income statement. Remember, I stands for income from continuing operations net of tax, D stands for discontinued operations net of tax. E stands for extraordinary gains and losses net of tax. And this is all the multiple step income statement. These are non-recurring items. So when I say it's never extraordinary, that means it's not E. But just because it's not E doesn't mean it's ordinary. Not extraordinary means it could either be income from continuing operations or a discontinued operation. You see that? Okay. So always extraordinary is when it's both unusual and infrequent, and that it's estimable. You can come up with an estimate for it, as well as negative goodwill, but only under the old standard, standard number 141 for business combinations and consolidations. This is only until May 31st of 2009. After that, standard number 141R, revised for business combinations and consolidations, becomes effective on the exam beginning July 1, and then negative goodwill is considered to be ordinary and not extraordinary. All right. If something is either unusual or infrequent, if it's unusual or infrequent, then it's typically put, if it's a gain, it's either over here, other revenues and gains. If it's a loss, it's put over here, minus other expenses and losses. That's where it's typically put on the multiple step income statement. Okay, let's see if we can do some multiple choice on this. Let's take a look at some multiple choice number 9 and number 11. Number 9 and number 11 are found on page 145. So let's turn to page number 145 and do number 9 and number 11. Number 9 says, in Witt's 2008 income statement, number 9 on page 145. Number 9 says, remember to read the stem first. In Witt's 2008 income statement, the total amount of infrequent losses not considered extraordinary should be what? The Witt Company incurred the following infrequent losses during 2008. $175,000 from a major strike by employees. Remember, effects of a strike, whether good or bad. By the way, the effect of a strike could be good. How could this happen if the effect of a strike could be good? Well, remember, one Christmas several Christmases ago, UPS went on strike. And when UPS went on strike, that was bad for UPS. But let me tell you who it was really good for. Federal Express. Okay, so the effects of a strike can be good or bad, but the effects of a strike are never considered to be extraordinary. So they want in this question what is not considered extraordinary. So 175,000 loss from a major strike by their employees is considered to be not extraordinary. The second item, 150,000 from an earthquake, which is unusual. Now they're saying that these losses are already infrequent. Now, if the earthquake is unusual, if it's both infrequent and unusual, then that is always considered extraordinary. So that's an extraordinary item. They want the items that are not extraordinary, so that doesn't count. So then you have 125,000 from the abandonment of the equipment used in the business. So if they abandoned some equipment, they probably had to write off the equipment, and then write-downs of all your assets, including receivables, accounts receivable, notes receivable, inventories, property, plant, equipment, all your intangibles such as goodwill and other types of intangible assets. These write-downs are never considered to be extraordinary. So if they want what is not considered extraordinary, that is also not extraordinary. So in which 2008 income statement, the total amount of infrequent losses not considered extraordinary would be the 175,000 for the major strike for employees, and also not extraordinary would be the abandonment of the equipment. So the write-downs of the equipment of 125. So the 125 and the 175 is a total of 300. The answer is 300,000. The correct answer would be B, like Barbara. Number 11. Number 11 also wants to know on page 145. So the correct answer for number 9 was 300,000. It was B, like Barbara. Number 11 says, what amount should Midway report in its 2008 income statement as an extraordinary loss before income taxes? So the extraordinary loss before income taxes is what? Remember that the extraordinary items, discontinued operation as well as extraordinary gains and losses, these are all reported net of tax effect. In order to take something net of tax effect, you take the amount before taxes and you multiply it by 1 minus the tax rate. When you multiply it by 1 minus the tax rate, that takes it net of tax effect. They want to know what amount should Midway report in its 2008 income statement and its extraordinary loss before income taxes. The Midway company had the following transactions during 2008. I'm doing number 11. $1.2 million pre-tax loss on foreign currency exchange due to a major unexpected devaluation by the foreign government. Sounds like a foreign currency devaluation. Well, foreign currency devaluation is never extraordinary. In this question, they want to know what's the extraordinary loss. So that's not it. How about the second bullet? $500,000 pre-tax loss from a discontinued operation of a division. Okay, well, if you have a discontinued operation, that gets reported here, net of tax effect. Remember, it's 2 lines. One line for all the revenues, expenses, gains, or losses. As long as you met all the 8 criteria, you throw it into the box. It goes in there. And then you have a separate line for the income tax effects. So that's a discontinued operation. So that's not extraordinary. They want what's extraordinary. Then they have the third bullet, which is an $800,000 pre-tax loss on their equipment that was damaged by a hurricane. Okay, this was the first hurricane ever to strike in Midway's area. Ooh, that sounds like an extraordinary event. Something's there that sounds both unusual and infrequent. Midway also received $1 million from its insurance company to replace a building with a carrying value of $300,000 that had been destroyed by the hurricane. So then they want to know what amount should Midway report in its 2008 income statement as an extraordinary loss before income taxes. Okay, folks, the hurricane is going to be an extraordinary event, okay, because it seems that it's both unusual and infrequent. Plus, the answer cannot be 0 because the answer is not 0 here. So something's got to be extraordinary, okay? Did you see that? There's no answer 0 here. So we have to choose something, so we're going to choose that one because that seems to be the most likely one, okay? What happens is you determine whether an event is both unusual and infrequent. Once the event is both unusual and infrequent, all the gains and losses associated with that particular event are considered to be extraordinary gains and losses that get put on the line. Now, let's just say that in the same year, the same accounting period, not only did they have a hurricane, they had an earthquake too. Now, if they had an earthquake, that would also be considered to be extraordinary, but you'd actually have 2 lines. You would have the extraordinary gains and losses from the hurricanes, and then the extraordinary gains and losses from the earthquake. And so you'd have 2 separate lines. And all the gains and losses from that particular event, which is a hurricane, or that particular event, which is the earthquake, you would net them together. Now, what's happening here in the third bullet is they had an $800,000 pre-tax loss on the equipment that was damaged by a hurricane. Then they had $1 million from their insurance company to replace a building. The carrying value of the building, now remember the carrying value is its historical cost minus accumulated depreciation. That gives you the carrying value is $300,000. So what happens is that they had a loss on the equipment of $800,000, but they had an extraordinary gain on the building. Now, how can they have an extraordinary gain? The reason is because they had very good insurance. What they did is they took the building and they insured the building for the replacement value of the building. So the replacement value of the building is probably $1 million. That's what they insured it for. But the carrying value of the building was only $300,000. So they recorded a $700,000 gain, which is an extraordinary gain because that gain occurred as a result of it being destroyed in the hurricane. Then you take that same event, because it's all the same event, which is a hurricane. Seems like they overinsured for the building and didn't insure any of the equipment. So they have an $800,000 loss because they didn't insure any of the equipment. So you take the $800,000 loss, net it against a $700,000 gain. It's all for the same extraordinary event, which is the hurricane. Net them together, you end up with a $100,000 extraordinary loss before taxes. Now, had they given you a tax rate, you had to take that $100,000 loss and multiply it by 1 minus the tax rate. But the thing is, they didn't give you any taxes here, plus they asked for it before income taxes. So the answer would be, you take the $800,000 loss, take the $700,000 gain, both from the same extraordinary event, which is a hurricane, net them together, and you get a $100,000 loss. So the correct answer is A. You can choose A, but you have to be sure. Okay, you can choose A, but you have to be sure. All right, the next thing that I want to cover is I do want to cover with you comprehensive income. Comprehensive income in your book does start on page 131, but I do a very nice job with comprehensive income on page 5. On page 5 of your handout. So please take a look at page 5 of your financial accounting and reporting handout, and we're going to take a look at comprehensive income. I see that I'm almost out of time on this disc, so take a look turn to page 5, and then I'll pick up going over the handout on page 5 of your financial accounting reporting handout on comprehensive income on the next disc. See you on the next disc.